41% price drop is just one example. We can talk about the top 5 markets for institutional buyers. We can talk about Tesla and IBM earnings. But we should start this conversation with Q4 GDP. Just to kind of give you a level set, what happened to Q3, we were up 4.9%. Expectations for Q4 were that to fall, collapse, drop, whatever you want to call it, to roughly 2%. Well, it came in at 3.3. 3.3. So again, we came in from 4.9 to 3.3, above expectations, above trend. Certainly not a recessionary number. In addition to that, there is a calculation inside of the GDP report called PCE. Remember, folks, remember, this is not the PCE that gets reported tomorrow. It's another cut or slice of the information. PCE headline was reported at 2.7. Core was reported at 3.2. Both of those year-on-year numbers. If you were to take it for the quarter, right, instead of annualized, you look at a quarter, headline was 1.7, core was 2%. So what might happen when the market looks at this data? They will scream soft landing, Goldilocks. The inflation monster appears to be slayed. More and more pressure on the Fed. Again, we will have a Fed decision next week. Again, I think there is no chance of a Fed rate increase. But again, this is where we are going and will. Will inflation continue to come in? Will growth stay positive? And we get a rate cut? We are going to see. Will it be March, June? These are all the discussions. But again, GDP came in better than expected. Inflation inside of the GDP report came in better than expected. Both on the soft landing path. How about the Bank Term Funding Program, the BTFP? It is shutting down as expected March 11th. If you don't recall what that was, this was this emergency program put together over a weekend after Silicon Valley Bank exploded because they had to sell treasuries, they had to mark to market, bingo bango, they were gone. This was a program where banks could go to the Fed and pledge treasuries at par or at face value instead of recognizing losses. Little did we know, inside the workings of the BTFP was a little window of arbitrage opportunity. This arbitrage opportunity happened to poke its head up around November when we went on this big rate drop. What basically happened? Well, these banks could pledge assets, borrow from the Fed in large numbers, and then lend them out again to the Fed for a risk-free arbitrage and make about half a point. Yes, folks, the banks saw a way to make risk-free capital with the Fed being both the buyer and the seller, essentially. That is now closed. They are shutting that arbitrage opportunity down, and the program will sunset on March 11th. But now my question. Here's my question. We still have a problem with bank balance sheets. We do. We just do. We absolutely do. I believe what is happening on the balance sheets is slowly moving away from treasuries to commercial paper, to commercial debt. So when I think about this bank term funding program shutting down, I ask myself this question. Will there be a new program announced? I think yes. Will it take other assets than just treasuries? Probably. If they don't do something and that option, that window is taken away, will we see more regional banks fail or be forced to merge? Probably. So, it is going to be very interesting to see what happens between now and March 11th. Again, Essentially, my guess is they will have more thoughts on a program, a second program. Maybe that program will expand and take other assets. I don't know, but you and I should be paying attention because I don't know how else to tell you. It's a bailout. It's a bailout. If a new program is created and that program allows other assets than treasuries, I don't know what else to call it except a bailout. It facilitates extend and pretend. It facilitates people who should be losing from not, and it's not what the capitalist system is supposed to be about. So we shall see what comes between now and March 11th. How about the rule of 100? I had never heard of this rule before. I stumbled across it with one of my readings. Here is the rule of 100. And in this case, 100 is hours. According to the rule of 100, if you spend roughly 17 minutes a day for 365 days in a row, you will be better at that thing than 95% of the population of the world. So, if you want to be in the top 5% of anything, simply practice 20 minutes a day for 365 days. Why is this important to me? Well, if you've been with me for this 5-year journey, you know that I talk about focus and daily discipline, and I ask you for 20 minutes a day. Get a buy box, look at the buy box, track it, do the numbers, network, all the stuff that we talk about here, 20 minutes a day. Without knowing it, I have been preaching the rule of 100. Again, the rule of 100 says if you do it for every day for 365, you will be better than 95% of the world. I don't know about you, but I like to consider myself in the top 5%. So again, use the rule of 100 on anything you would like and enjoy the fruits of your labor. Alrighty, folks, there's lots and lots of doomers out there sending out headlines about huge discounts on properties. It's a sign of the crash that's coming that's not really here, but hey, they got to get paid somehow. So get ready. Get ready for the doomers to tell you about a $150 million property in the Hamptons that was tied up in bankruptcy court that went to auction this week and sold for $88.5 million. Folks, that home crashed 41%. I guess all of Hampton real estate is now going to fall 41%. No, that's not how it works. But that's what they want you to believe it works. That's just not how it works. But yes, folks, there is a house that fell 41% from list price and retraded at $88.5 million. When you show me, I can't, especially on Twitter, when you show me one house that had a big discount, do you really think that's how the real estate market works? It's exhausting sometimes. Twitter's exhausting. Oh, how about Alex Hormozi? So, first off, let me thank all of you that visited Omar's channel yesterday, the department, and saw my hour discussion encouraging W-2 employees to take their passion and hobbies and do something with it. I have done my best to go back to all of your comments and recognize you and say hi. So thank you for going to Omar's channel and watching our discussion. Hopefully you enjoyed that. But one of the things in the video that I harped on a little bit is that folks like Alex Hormozi, Cody Sanchez are glamorizing entrepreneurship, are glamorizing, the 1% that come out and make millions. Alex Hormozi yesterday put out a video that said, I want to make sure I get it right, getting rich isn't fun. Getting rich isn't fun. He's right. It isn't fun. Right? In that video that he put out, which I love the way he does it, it's just who he is. He's on like 6 or 7 Zoom calls. He's doing all of this. It's not sexy stuff. When I tell you about my 15-year journey of not spending any money, of my friends and family making fun of me, and all these other things. Getting rich isn't fun. It isn't sexy. Getting rich, I want you to hear me here. Getting rich, the act of getting rich, does not look good on social media. I'll say it again. The act, the process of getting rich does not look sexy on social media. That's why everybody does this get rich quick and this flexing and all this stupid consumerism. If you want to get rich, it is a process. We've talked about it a lot. It is there for you, but you have to make choices. You have to stick to those choices for a long duration, but it is possible. And I applaud Alex Hermosi for telling everybody the truth. It's not fun. It's not guaranteed. It's not sexy, but it is possible. So shout out, Alex. How about the top 5 markets for institutional investors? Folks, if you are not signed up for Resi Club, I don't know what you were doing. He put out a note yesterday talking about, I think it was the top 20 real estate markets where institutional buyers are. Basically, the metric is how many units do institutional buyers have, how many total, and what percentage. We're going to talk about the top 5. If you want to see the list, go to resiclubanalytics.com, give your email. It's free. What are you doing? Go get it. It's free. But here's my question for you. We're going to go through these top 5 markets, and I want to ask you, is being in a market dominated by institutional investors good or bad? Is it easy for mom and pop to buy around them and just be cheaper and better? Is it a sign that maybe you shouldn't be there because it's oversupplied? I really don't know. So I'm going to read off the top 5, and I want to hear from you. If you are in one of these 5 markets, is it a green flag, red flag, a big nothing burger that institutional investors dominate that market? Let's start with number 5. We'll go backwards. Number 5 is Jacksonville, Florida. According to Resi Club, there are 5,150 rental homes owned by institutional investors. That makes up 31% of the entire market. So roughly speaking, 3 in 10 rental homes in Jacksonville owned by institutional investors. Number 4, Indianapolis. 3,929 homes owned by institutions. Again, 31% of the entire market. Number 3, Charlotte. 6,661. I love the fact that these are exact numbers. Resi Club doesn't round. It doesn't lose these hyperboles. It's like, this is the number, it's the number. I just love that. So again, Charlotte, 6,661. That is 32% of the market. Basically 1 in 3. Number 2, we're going backwards. Winston-Salem, 954. But that makes up 33% of the market. So again, I don't know anything about Winston-Salem. Apparently it's a pretty small market because again, if you have 954 and you are 1/3 of the market, that's a lot. So the number 1 market that institutional buyers are involved in, I actually would have guessed this one. This one I would have gotten right. Atlanta, Georgia. But damn, they got a lot of homes in Atlanta. 18,406. That is 36% of the market, basically 2 in 5. So I ask you, if you are an investor, mom and dad, mom and pop in Atlanta, is it a good thing that you have institutional buyers or owners so you can rent just under them, give better service? Is it a red flag because they have too many units? I really have no idea. I love the fact that we know this data, but I don't know if it's good or bad. And maybe it's nothing. Maybe it's neutral. I have no idea. Don't have the data on Fresno. But yeah, it was pretty interesting. So anyways, How about some earnings? Why don't we go to IBM first? We'll go IBM. IBM beat top line, beat bottom line, and raised guidance. In addition, IBM announced job cuts, about 3,900 job cuts. You're going to start to see lots of companies issue job cuts, little rounding numbers. It's still going to be meaningful. On that topic, because it is Thursday, we got unemployment claims up to 214,000. Expectations was 199. Last week was 187. So this was a pretty big jump. This is about 25,000 jobs in 1 week. So we got to watch this. Again, it's a weekly number. It does move a lot. But maybe this is the trend. This is the start of a trend towards 300,000. We shall see. But yes, IBM tweaking. Then there's Tesla. Again, Tesla is one of those stocks I wouldn't touch with a 10-foot pole. It's got a lot of passionate people that either love it or hate it. It doesn't seem to have anybody in the middle, which to me, I don't want to play there. But they missed top line, missed bottom line, issued a weak forecast, and did not talk about deliveries. I don't know how you model future profits and earnings if you don't have kind of expectations. So we shall see. I did not check Tesla stock this morning. I'm going to guess it's down based on that fact. So again, lots of stuff going on. I do want to let you know about one thing. Again, if you're out there, I will be going to the Think Media event in April. I have already bought my ticket. And second, I will actually be a speaker at the upcoming WealthCon. Yes, Ryan Pineda's event that happens in Las Vegas. I will be one of the speakers. If you go to WealthCon, I think it is late April. I believe it's at Caesar's Palace, but you can go see it. I'm on the list. I'm way at the bottom. If you scroll the speaker list, I'm way at the bottom, but there's a lot of great folks coming. So if you're going to go to WealthCon, let me know. I'd love to see you. Bring your book. I'll autograph it. We'll have a good time. So at the end of the day, we are down to the event. My event, February 17th and 18th, is sold out. But if you want to do the virtual event, we are at 64 tickets. We do have some more left. So hopefully I will see you there. Have an amazing day. Thanks once again for the support by watching the interview with Omar. It was greatly appreciated. If you go there today and watch it, leave a comment. I will do my best to give you a shout out and say hi. Take care, folks. Bye.